Good day, my name is Dean Crocker. I'm an equity analyst with the PSG Wealth team, and today I'll be taking through our latest EI report completed on Anglo American Platinum. So on the 26th of July, Anglo American released their first half results for the full year 21 period. The results were characterized by substantially higher earnings. This was where the group was able to benefit from an improvement in production volumes, particularly given that the first half of 2020 was impacted by COVID. The group also then utilized the higher production volumes to take advantage of the higher commodity prices, with the group generating a 47% improvement in the PGM basket price at $2,884 per ounce. This paved the way for free cash flow generation, which was threefold improvement to 5.3 billion, and subsequently resulted in a 584% increase in the ordinary dividend at 70 Rand per share, as well as the declaration of a special dividend of 105 Rand per share. In terms of the valuation, on a forward EV basis, the group is currently trading at a 51% discount to its historical 5-year average, and a 27.4% premium to its FactSet peers. It is however worth noting that the group generally does trade at a premium to its peers. This premium is generally for about 28.1%. Thus, it does seem that the group is fairly tradable relative to its peers, however, it does seem to offer value relative to itself. It is however worth noting that the metrics relative to its 5-year average do look a lot more appetizing, given that the group is trading off such a high base. They were able to take advantage of the higher PGM price, given that they were able to bring to market a lot more volumes. This is really testament to management and shows you what a strong commodity company can really achieve if they're able to continuously sustain their volumes and take advantage of these price anomalies to a large extent. In terms of the group as overall, it has really been a strong counter. We do like Anglo American Platinum. They are highly cash generative, well diversified, a big player in terms of South Africa as well as the global PGM market, and a low-cost operation, particularly given Mogalakwena, which operates at one of the lowest costs around. This does, however, seem that the group is fairly valued at current prices, and it would appear that the market has priced in all future growth. It is quite difficult to grow off such a high base, particularly given that we have seen a bit of a pullback in the PGM basket price over the last 3 months. And on the back of that, we have, however, increased our recommendation from an underweight, which was released previously, to a neutral position, which is where we currently see the company. In terms of the income growth portfolio, we generally look for companies which are a lot more stable in nature, which are able to offer long-term dividend yields in excess of certain valuations. Unfortunately, given the cyclicality in commodity companies, it doesn't really fit that criteria. As such, we've maintained our underweight recommendation for the income growth portfolio. So with regards to the event, Amplats released very strong results. You can see on the table that effectively everything was significantly higher. It is difficult to compare given that first half of 20 had been impacted by COVID-related costs, thus they weren't bringing as much production to market, and this had a subsequent knock-on effect throughout the entire group. However, if we do look at the first half of 21, the groups look substantially better. They reported strong revenue growth, strong underlying EBITDA, which facilitated nice free cash flow generation, which allowed them to declare significant dividends in the form of both ordinary and special dividends back to shareholders. This buys a lot of shareholder goodwill, as it does offer a nice cushion in terms of any fluctuations in the share price. In terms of the impact on data release, the market received the results very favorably. It increased by 0.88%. Whilst the JSE was only up slightly. In terms of the year-to-date performance, Amplats has outperformed the benchmark by 3.8%, with the year-to-date return of 22.8%. If you do look at the table, you can see it's generally green, which is very nice, apart from the 3 and a 6 month valuation. And in terms of that, we have talked about it, but we have seen a bit of a pullback in a lot of the commodity prices over the past 3 to 6 months, hence why there's been a slight underperformance. With regards to our last recommendation, which was released in February 2021, the recommendation was an underweight. Since our recommendation, the counter has, however, underperformed by 1.17%, so largely in line with the market. So in terms of the assessment, Amplats in the reporting period really benefited from the ability to increase their production back to normalized levels and take advantage of the higher PGM prices. Their costs were not inflated significantly, albeit that there are some COVID-related costs. And they've also taken advantage of the excess cash flows to return a lot of the excess money back to shareholders, which is what good shareholder goodwill, and also add a different value proposition to the counter. We have, however, seen a pullback in terms of PGM prices for the last 3 months, probably a bit more normalization of those prices, with the biggest faller being rhodium. Now, it must be worth noting that rhodium is predominantly found throughout South Africa and only in the South African miners. And it was really a nice cash flow generation item for the company. You will see in the year report that it was actually the biggest contributor to the group's underlying performance in the latter period. We do expect that the PGM prices will remain at the current levels. There's quite a bit of demand coming through from China. It is a niche market in the sense that it ties in largely with the ESG requirements of the world, particularly in terms of carbon neutralization. We do see that the EV market could be a potential headwind in the future, but as it currently stands, the combustion engine is not going anywhere. And the demand for platinum and palladium and the likes will continue. In terms of the jewelry market, we've seen a lot of demand coming through from China as the economy started to unwind and reopen, and this has helped to maintain the prices of rhodium and palladium at higher levels. We do, however, expect that it might be quite difficult for the group to achieve substantial growth of the current high base. It will now become a factor of efficiency in terms of operational efficiency, rather than just relying on substantially high commodity prices. That's not to say that if commodity prices grow or improve, the group will continuously take advantage of that, and they're well placed to do so. But it is now coming down to the point where the operational efficiencies will become a lot more important for miners. We do expect that the dividend yield should remain for the next period, as the current commodity prices have been able to facilitate that, and PGM market has seemed to have stabilized at current levels. So on the back of that, Anglo Plats, it remains a sound company, strong balance sheet, well diversified, very good operations which operating at low cost margins. We do just see some headwinds in the form of PGM market probably pulling back. And as such, we have upgraded our recommendation from an underweight to a neutral for the equity portfolio. Should you wish to place a trade, please speak to either your financial advisor or the trading desk. We're more than happy to help you. Please take note of the disclaimer and have a good day further.